welcome to a special San Francisco edition of Mad Money. Welcome to Cramer. Other people make friends. I'm just trying to help you make some money. My job is not just to entertain, but to educate, to teach. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Today got real ugly. But at least we finally have something that can make the Federal Reserve itchy to cut interest rates sooner rather than later. Bank loans gone bad. Nothing motivates the Fed to move faster than credit losses because they're a definitive sign that the economy is going south. There are early warnings that it's time to ease, and the banking system has now provided us with enough questionable credits in 1 week that the Fed can move swiftly to slash rates without all that much worry about inflation. Of course, when you have something as grave as credit losses at banks, the market doesn't react well. It's a sign that until the Fed eases, perhaps aggressively, banks will make it harder to borrow money and layoffs could be on the horizon, which is ultimately why the Dow tumbled 301 points today. The S&P dropped 0.63%. NASDAQ sank 0.47%, even though it was up in early morning. Still, though, the Fed's in a constant tug of war between cutting rates to spur economic growth and leaving rates alone to prevent a resurgence of inflation. With the regional banks getting crushed by bad loans, it's much, much easier for the Fed to go with the former analysis. Lower interest rates do many things. They can make housing more affordable, cranking up an industry that, you know what, it's probably in the worst recession in ages. They can make it easier for businesses to expand, and they make dividend stocks more attractive in comparison to the bond market because Treasury yields have suddenly fallen to lower levels than anyone was expecting. Boy, did that happen today. Many of the consumer packaged goods stocks, for example, are starting to put in some serious bottoms. I like Campbell's, maybe General Mills. They're following PepsiCo, which had its yield rise to 4% on stock price depreciation, not a dividend boost not that long ago, and then saw stock rocket more than 10 points on a better-than-expected quarter. Here's some predictions. I think Kimberly-Clark could be bottoming. Procter & Gamble already started the process. But much, much more immediately, lower rates make it easier for borrowers not to default. That's what's so welcome about the bad loans that plague these regional banks, echoing the cockroach theory that Jamie Dimon talked about in the J.P. Morgan conference call this week. In reference to subprime auto lender Tricolor that went under and auto parts company First Brands, both of which filed for bankruptcy. As Jamie put it, when you see one cockroach, there are probably more. Sure enough, a couple of cockroaches surfaced almost immediately. The two major bad loans at Zions Bank and a sour loan at Western Alliance Bancorp might be on the hook for. Now, it's possible there's foul play involved in that multi-billion-dollar problem of First Brands. Doesn't matter, though. A bad loan is a bad loan is a bad loan. And that's good for the stock market because these bad loans won't hurt profits of anything other than the banks. The pain will be contained, I think. I also believe the banks are pretty prudent these days, much more prudent than they used to be, at least when it comes to money lending, because there's a perception that the Trump administration's appointees might hire bank examiners who will go easier on the industry. Look, the president's more pro-business than the previous guy. But when I was in Washington running a panel at the Federal Reserve Bank, about what small and medium-sized banks need to do to succeed last week, the three execs I interviewed all pleaded for lower rates. The regional bank index, down more than 6% today, makes for a pretty compelling argument to cut them. I believe the bankers. To me, these credit woes just made the case clearer. Now, what do the big institutional money managers glom onto when we get bank credit issues? They tend not to distinguish between the good and the bad and the ugly of the financial industry. Just go back to the last banking crisis, the miniature one in the spring of 2023, when many banks had balance sheet stress because they owned a lot of low-interest bonds at a time when interest rates had a very sudden rise. That generated surprising outflows that caused 4 banks to fail, often hindered by uninsured depositors who wanted their money out fast. All bank stocks went down during that period. But that was also the beginning of the run in what became known as the Magnificent Seven. Investors traumatized by the prospects of a credit crunch fled to companies with such deep pockets they'd never need to borrow money. They fled to big tech companies that, like nation states, were sovereign and didn't need to raise money to expand. Can that happen again? Hard to say. As someone who spent the last 4 days interviewing tech executives, I can tell you that we spend more time talking about whether tech's in a bubble than we do about what the future of tech actually looks like. There's been so much money spent on artificial intelligence by these 7 companies that some assume that they'll finally end up being cash-strapped. I met very few people who think like I do, which is that we're embarking on the 4th industrial revolution, and the spend is a necessity. That controversy could hinder the migration from stressed areas to growth zones. 2 years ago, those companies didn't have anything big to spend their money on. Now they do. One thing I did hear over and over and over again is that artificial intelligence is causing companies to spend less on people, more on tech. Once that tech investment is made, these companies will be able to get more out of their workforces, allowing them to grow faster and more efficiently. Of course, there's a whole other group of people who say that if growth is possible with fewer people, why not fire a huge chunk of the workforce and make more money out of the static revenues? Earnings per share can go higher on the same sales when you're more efficient and use artificial intelligence. That said, all of this is in flux. We don't know how many cockroaches are out there. The rewards from artificial intelligence aren't nearly as clear as the bulls would have you believe, because it's often too unreliable to be used in important decisions. You know that, and I know that. We catch GPTs and mistakes all the time. However, if the bad loans really tend to be made by bad bankers, or there's fraud, the Fed cutting interest rates would be simply helping the good banks. That would boost the real economy. What is the real economy, you might ask? Oh, remember, in Mad Money, we have a tripartite stock market right now. There's the stocks that are related to the data center. That's one. The stocks that are owned by speculators. That's two. And those that are a part of the actual economy, both service and industrial. The bottom line, those real economy stocks will be the winners in the rate cut scenario that I see playing out. Those stocks have been in the doghouse long enough. Only bad regional loans can spring them, and the credit cavalry's right on time. The speculative ones, please join the monster sellers we saw today and ring the darn register. On at least part of your holdings, enough money's been made in that cohort already. You don't want to give it back. Let's take calls. Let's go to Ryan in Massachusetts. Ryan.
Hey, Jim. How are you doing, my friend?
I couldn't be better. How about you, Ryan?
I'm doing great. Just wanted to say, Jim, I'm 21, just got into investing, and I love your sage advice. My question is about Align Technology.
I want you to go. I know it's a low-priced earnings multiple, but I just think there are a lot of forces against it. Let's move on from that one. Mark in California. Mark.
Booyah, Jim.
Booyah, Mark.
Welcome to the Bay Area.
Oh, I love it out here. Thank you so much for having me. What's happening?
I got a question about ISRG. They did really well beginning of this year. I know tariffs are hitting them. A couple competitors. What do you think? Where are they going?
You know, I have to tell you, things have gotten tough for these guys. There's a lot of people that have moved in their industry. I think it's a great company, but the stock is telling me, don't buy me, don't buy me. And I'm hearing the stock. All right, look, I think stocks tied to the real economy will be the winners in the rate cut scenario I see playing out. And the cavalry, well, couldn't be coming in a better time. Oh, man, buddy, tonight, we have another big West Coast show. I'm sitting down with the CEO of Lyft to learn more about how the company is competing in the ever-changing rideshare space. Then, Prologis reported a quarter that shot the lights out, and with a renewed focus on the data center build-out, I'm hearing what's in the pipeline with the company CEO. And while we're out here, we have heard a lot about agentics, but we have not heard even squat about you can use the agentics to get in. We need cybersecurity to stop them. I'm discussing the importance of this technology with Okta's top brass, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
So far this year, we've seen a spectacular more than 50% rally in Lyft, the number 2 ride-sharing platform that's finally getting its due after years of sideways trading. I suspect it's got more room to run. Don't take it from me. Let's dig deeper with a man who's, I think, created a miracle here. I'm talking about David Risher, the CEO of Lyft, to learn more. Mr. Risher, welcome back to Mad Money.
It is great to be here. Great to have you here on the West Coast.
Thank you. Before we talk about the miracle, I want to talk about something I heard about you, and I love it.
Tell me.
You periodically drive a Lyft.
I do.
And what have you discovered?
So first thing is, I love it. It's super fun. I mean, and it's fun for two reasons. It's fun because you get to experience the driver experience, and it's complex. You're simultaneously taking in information, trying to navigate the streets, understanding the vibe of the city, and so on and so forth. And then you're trying to kind of work with whoever's in your back seat and try to give them the best ride of their life. So super, super fun. And I always learn something about why people choose Lyft or even the other guys.
It does seem, from what I see about the difficult to measure retention, that if someone is a driver and they start doing more rides, I think that means that you're being successful.
I appreciate that. Yeah. We have a 29-point advantage over the other guys for drivers who drive for both. And that's really important, because how can you provide great service unless you're really committed to doing the job? And the drivers who drive on our platform tend to like it a lot, and it's also super helpful for them. They get to make money.
You are a very modest person, but I'm going to ask you, before you got there, what was that level?
Not as high. Okay, a lot of that's come over the last couple of years. One of the things I did right at the beginning is I said, in every car, there are two customers, a rider and a driver, and they both matter.
I like that. Okay, so you're at the forefront of driverless, this partnership with Waymo, which, by the way, has been revealed to be the best there is in terms of driverless. How's that working?
It's great. So we've just gotten started. So this will be starting sort of on the ground in Nashville next year. But the idea is simple, which is, look, they have amazing technology, self-driving tech. If you haven't taken it yourself, it's safe. It knows the rules. It kind of plays by the rules and so forth. So it's a great rider experience. So we're going to be able to create what we think of as a real hybrid network in Nashville, which is to say, there'll be drivers on the platform, there'll be self-driving cars on the platform, and whichever you want as a rider, you'll be able to get.
Well, that'll be interesting to see which. I bet every city in many ways has its own quirks on that.
I bet that's right. I think different cities have different vibes on that.
Absolutely. Now, you have been at the forefront of creating new. Not come on, so to speak, but new reasons why you would take you over the other guy. Remember, we talked about women and connect. I like this idea about the older Americans who aren't as facile with this.
Yes, 100%. Yeah, so that's called Lyft Silver. This was one of the things. Here's something I find. So CEOs, people think, CEOs have infinite power. They come in, wave a magic wand, things get done. Okay. It took me 2.5 years to get this product out the door, and I was very passionate about it. Part of it is I'm an older guy, and so I have maybe a certain amount of empathy for older parents and that conversation that you have where it's like, Mom, Dad, I think it's time for you to give up the car keys. Nobody likes that conversation. Nope. So anyway, eventually the whole team rallied around it. It's been out in the market for about 6 months now. Incredibly successful. It's called Lyft Silver, as I say. It is.
I think that's great because it is considerate and does make that conversation easier. I had it, and it was just one of the worst moments of my life. I
mean, this is the thing. I don't want anyone to ever have that conversation. Instead, I want them to have the conversation, Mom, Dad, I've gotten you Lyft Silver, and that's going to make your life better. You're going to be able to come and see the kids' soccer games. You're going to be able to be out and about, go to the grocery store, go to your manicure appointment, get to your doctor's appointment, and not have to worry about it.
I think that's sensational.
Thank you.
It really is. Now, you are also great at coming up with partnerships. Got a new one, Chase Sapphire Reserve.
Yeah. So we've been working with Chase for years, but we refreshed the whole sort of value proposition. Now you get 5x the points, and you get $10 a month. So if you're a Chase Sapphire Reserve card holder, you got to be, activating it and using it on Lyft. We also have United Airlines coming up real soon.
Right.
Yep. So we announced that earlier this year. Super excited about that. We're going to do a lot of innovative work, I think, with United to sort of bring the experiences together. So really excited. Yeah, partnerships are a big part of what's driven our quarter after quarter after quarter growth.
Well, it makes it so that, look, I want new and exciting. That's what people want. I also want superpowers. Can you give me superpowers?
We're working on it. I'd say the superpower we're working on right now, which is instant pickup. I want basically the pickup to be so fast you can't even believe it. It's going to take a little while, but that's a superpower.
But how could that possibly happen?
Magic, AI, data science, machine learning, drivers who want to perform a great service, the whole thing.
And Europe?
Yeah. So last time you and I talked, we were only domestic.
Right.
Really only in the United States. Had just kind of gotten a little bit of traction in Canada. But now we've realized, gosh, Canada is growing almost double year on year. We're also live in Puerto Rico, obviously part of the United States, but not part of the continent. And so as we've looked at the success we've had there, we said, it's time to spread our wings and go to Europe. So we acquired a company called FreeNow, amazing company. They are the best what's called a taxi aggregator in Europe. So it's a great way to order a taxi all across Europe, 9 countries. And they've been growing. We're going to grow, and we're going to grow even better together.
All right. Now, when I first met you, stock was single digits. I was very worried. I told you, look,
I remember.
This is going to be tough.
I remember.
I don't know. You've been very successful in a lot of things. I'm worried. And you told me, look, I'm aware of the problems. I'm aware of the balance sheet.
Yep.
Now, how about this? You reduced the share count for the first time in company's history with a repurchase.
That's right.
That is often, to me, the sign that whatever may be ailing you on balance sheet is no longer ailing you. So tell me what made you think that it was the right time.
Yeah. So when we first talked, I think over the trailing 12 months, the company had consumed, call it $1 billion.
No, it was like I couldn't go. I was like going like this.
Right. It was one of those like I don't even want to see this number because it's just too big and too negative. Yeah. So in the last 12 months, I think we generated about $930 million in cash. So very, very different situation right now. We've really taken a company, and it's a comeback. I mean, look, this is there are big stories that people tell. There's the tragedy and there's the comedy. This is the comeback story. This is a company that had great roots, all sorts of innovation, and then maybe lost its way a little bit, and it's been kind of on a tear the last couple of years. So we just looked at the balance sheet, we looked at what the cash we're presenting, and we said, you know what, we can afford to do this and still have money to buy Free Now, and still have money to buy TBR, a company we just announced yesterday, and still have money to invest in innovation. So,
all right, now you had great private sector, and then you went to Africa. You taught more people to read, I believe, than any one person in the world. I think you deserve that because it's what you did when I looked at your background.
Yep.
Now you've been here, and you could say, you know what, I want to declare victory that we're actually buying back stock. But you seem like you like your job more than ever.
I love my job.
You love it.
I jump out of bed every morning. In fact, on Saturday mornings, I jump out of bed, and this is the team, cover your ears, but I say like, man, I wish it were Monday. I gotta get back to work. And my wife says, David, settle down, would you please? But yeah, I mean, we have so much cool stuff we're working on. And I think, look, our vision, our promise to everyone is we want to serve and connect. I want to serve riders and drivers better than they've ever been served before.
Safer. For women, that was a deal that changed my wife's mind about who to call.
Hugely appreciate that. And that's it. Like, I want every single customer to feel safe, to feel taken care of, to feel like they're getting the best service they possibly can. And I want to connect people in the real world. And this, I mean, you know this. Like, you and I will do stuff on video. It's fun, but it's more fun to do face-to-face.
No, that's why I'm so glad. But I heard you could be around because I did want to congratulate you in person. It's one of the great turnarounds I've ever seen. And it was one that, frankly, was not easy. I was concerned because it did take a miracle.
Turnarounds are tough, but when they work, they are super, super fun and satisfying. And we got a lot more ahead.
I know you got more ahead, definitely. Yeah. That's David Richards, the CEO of Lyft, Lyft. You can tell how enthusiastic I am about this. It's an amazing situation. He's just an amazing guy. Mad Money's back after the break.
Coming up, Cramer's getting a post-earnings checkup on the logistics space. Don't miss his exclusive with warehouse REIT Prologis. Next.
A bit of a slowdown in parts of commercial real estate, including warehouses. It's weighed on the entire industry, including the stock of Prologis. But this week, the company reported a quarter that made people forget the tougher times, and it married that with a report of a very positive outlook. Are the cloudy times behind the industry? Can the stock keep running? Let's check in with Hamid Moghadam. He's the co-founder, chairman, and CEO of a company I have liked for many years, Prologis, to find out more. Mr. Moghadam, welcome back to Mad Money.
Thank you, Jim. Good to be with you.
Okay, you said something on really a Boolean conference call that I loved. You said, this is one of the most compelling setups I've seen in 40 years. This was a level of sunshine that brought a smile to my face because everyone's got something negative to say. How is this possible?
Well, look, we went through a period of significant construction right after COVID because the share of e-commerce during COVID went way up and people built anticipating that kind of demand. And vacancy rates went from about 4% to about 7.5%. Some pricing power went away. But today, we're at the trough. We already see signs of companies committing to a significant amount of space, particularly the strong ones. The small and medium-sized businesses haven't quite come back, but the ones with strong balance sheets are they have their front foot forward and on offense. And replacement cost of this kind of real estate has shot through the roof. There are many jurisdictions that are putting opposition to development of new logistic facilities. So you're getting set up in an environment where demand is coming back, supply is going to be curtailed, and I think companies are going to have a fair amount of pricing power. And to get that next unit online, it's going to be a lot more expensive.
But you have some prime real estate.
We do.
And if you need to add, I am sure even with the inflationary costs you have to deal with, it's going to be a really good return on investment.
Absolutely. No question about it. We have 1.3 billion square feet that will benefit from the strengthening market. And eventually our development business on the logistics side will be very active again because we're already doing a ton of build-to-suits. And certainly on the data center side, we're doing a lot of new development projects.
Well,
so we're excited about that.
I do want to talk about that, but just want to finish that people should understand that the focus on your last conference call, other than the fact that you will be retiring soon, was the focus on leasing momentum. It just seemed like around the globe, not just the United States, and in countries in Latin America, the leasing momentum's terrific.
Latin America's on fire, and the reason for it is that they're pretty much way behind everybody on e-com, and the e-com wave that we got in the beginning of COVID, they're getting now. So there's a massive demand, and some of the nearshoring of manufacturing has been benefiting Mexico. So that's why Mexico and Brazil we're very excited about. But it's a good setup, and I think when it turns, which it already is beginning to, I think it's going to have long legs because of this cost differential.
Right. Now, let's talk about the data center. You were the first and still, I think, the only company that talked about both data center and the power needed for the data center. People are kind of waking up to the idea, you know, we just can't put up a data center. We have to find the power, and they're all so nervous about it. But you offered a turnkey solution.
Right, absolutely. I think the real issues on the data center side, to state the obvious, is availability of power, reliable power. But that's not the only constraint. The components that go into these data centers, the supply chain hasn't expanded. So getting the parts to go into a building for a data center are becoming scarcer and scarcer. So companies like us that have a balance sheet and the ability to pre-commit for purchasing some of these components are in a position to deliver faster for our customers, which is a huge competitive advantage.
Do you see overbuilding going on in the industry?
No, not right now, because the power is a governor, and all these 4 or 5 large hyperscalers are in a race to build capacity in front of the demand for AI.
You decided that you wanted to go with as much renewable power as possible. That seemed like you did that before anyone ever wanted it or knew that they needed it. Now it's going out of fashion, but it's never wrong, is it?
Look, renewable power, it was the surface of our buildings, the roofs, that were being underutilized. So we had, in effect, free real estate, and it was the cheapest form of energy we could generate. It wasn't because we were trying to go to heaven or anything like that. It was just good business.
That's not a bad destination.
That's not a bad thing, particularly as you're getting close to retirement. So, so we're really excited about that potential. The renewable got us into discussions with utilities and building relationships with utilities, which is where the grid power comes from. So I think of our energy business not just as renewable, but also on-premise generation of energy, which is going to be increasingly important, because to produce energy centrally and go through all these environmental constraints for transmission is going to take too long.
One last question. E-commerce multiplier effect you talk about, it's back, it's big, it's not going down, it's going higher.
It's going up higher for reasons that we actually you and I discussed many years ago, which is with every passing day, the customer's expectations for delivery time is getting shorter, and their expectations for variety and choice is getting higher. The only way the math works on that is to put more real estate closer to the customer.
All right, well, I do want to say, and I hope I get to see you again one more time, that you have been a tremendous teacher to me. People come on the show, and I'll do the interview, and I think people have to understand, there's some people who come on, and that's it. Then there are other people who come on, and for the last 20 years have taught me how to do my job better. Hamid, that's what you are, a teacher.
Well, thank you, and I doubt that, but I appreciate the comment nonetheless.
That's Hamid Moghadam. He's the co-founder, chairman, and CEO of a company that was the first to bottom, by the way, in the Great Recession, Prologis. Mad Money's back after the break.
Coming up, how are companies updating their security in the age of AI? Cramer's finding out with the CEO of Okta. Next.
out here in San Francisco, it's worth digging into why this market's gotten so hostile to enterprise software. Even the parts of the sector that previously seemed like ironclad, like cybersecurity. Take Cramer family favorite Okta, the leader in identity verification. These guys have excellent numbers and a very strong business. The last couple of quarters showed good strength, yet the stock's actually down more than 30% from its highs in May. In fact, it's even below where it bottomed after Liberation Day in April. No matter what Okta does right, it doesn't seem like the market cares. So what's it going to take to turn this stock around? I wish I knew, but earlier this week, we sat down with Todd McKinney. He's the co-founder, chairman, and CEO of Okta to get some answers. Take a look. All right, Todd, I'm at the Mecca. It's where all I hear are the greatness of agentics. And they're just like us. You can't tell the difference. But wait a second. How about if they are programmed by bad guys? Would we be able to tell the difference?
Yeah, agents are exciting. There are these entities that have access to data and they can make decisions. And the way we think about it at Okta is they're a powerful new identity type. And identity is what we're all about. And we know that identity can be a force for good. It can connect people to systems. But in this case, if the bad things happen when the agent's in the wrong hands, because it can do bad things as well. So we're really trying to manage it as this powerful new identity type.
And you've come up with the identity security fabric. How does that work?
It's an important concept. It's a simple concept. Just like in the early days of Salesforce, it wasn't CRM. CRM didn't exist. It wasn't a category that exists yet. It was sales automation and support and marketing. Same thing in our industry. We're going from an industry that was access management and privileged access management, identity governance, to this new category, which is called the identity security fabric. And the idea is simple. It should all work together, Jim. It should all be integrated and be low cost and low risk and get the results people want.
Are people calling you and just coming to you and saying, what do I do? Because a quote that I saw from Octane, your terrific show, 90% of the customers have agentics in production. So they're already ready to go. But only 10% express confidence to govern them?
Well, what's happening is everyone's so excited. Boards of directors.
You catch it.
CEOs, boards of directors, they're going to the teams and they're saying, do AI, get it in production. And as an industry, I don't think we've done enough to actually give the governance, the security, and the control. And you're seeing this in data breaches that are happening. These agentic systems that are pushed out without the right governance and control, it's leading to bad outcomes, personal data being exposed on the internet. And if we don't get the governance correct and the control correct, we're going to undo 10 years of progress in security, and it's not going to be a good result.
Well, you're the person who I think from the very beginning explained to me identity, and I didn't realize that the way the bad guys get in, they just walk in through being someone else.
Yeah.
They don't crack in like a safe cracker. This is not like that.
Yeah, they can take control of something that was intended for something else. It's like what happens if you think about a big problem right now is people calling into support desks and tricking the support desks into changing account permissions. So that is an identity type. That identity of that system is supposed to be bound to one person, and without the right controls, it could be tricked into another person. And the same thing could happen with AI agents, which is why it's so important to bring AI agents into this identity security fabric so it can be governed and controlled. We'll have complete visibility on what these agents are doing.
Oh, well, speaking of visibility, I don't want to skip the rest of your business. It's obvious we're here to talk about agentics, but you've had some great success of late with the Defense Department, with federal. I'm a little worried, and maybe you can assure me that the fact that there's been a government shutdown doesn't necessarily stop the calls, because, boy, you've been on a roll there.
Well, the government may shut down, but the systems don't shut down.
Okay.
These are critical systems that are connecting people from the DoD to mission-critical systems that are connecting people in the civilian agencies like the State Department to their critical systems to get their job done. So the technology requirement or the identity requirement is even getting more and more.
But do your salespeople have anyone to talk to?
They do. In cases that they're having to talk to fewer people as the government deals with the shutdown. But there's people that are buying software and that are deploying our services and keeping the government running.
Okay, now, 2 quarters ago, you talked to me about macro headwinds, and then you told me they didn't materialize. I'd like to think that the government shut down without a lot of data, that things aren't slipping. We're all kind of at sea, Todd. We don't know whether whether more people are being hired, fewer. I hope that the Fed does, but you might give us a little inkling.
I think there's a lot of change. There's a lot of change with a new administration last year. There's a lot of change with technology. The AI revolution is it's the biggest platform shift since the internet. It's making everyone just make sure that everything's in order. But what we see is the economy keeps plugging along.
All right, that's good news. Now, I also think that there's something you can help me. There's a kind of a negative view out here about software, not about software as a service, as opposed to just ChatGPT.
Yeah.
I mean, no one can really use ChatGPT to create what you would create, right? I mean, that would be a dangerous game.
Software is definitely evolving,
Right?
like it did for all the other technical revolutions, whether it was the internet 25 years ago, or whether it was cloud computing, which was Salesforce and Okta was born in the cloud, whether it's mobile and social when everything moved to the iPhone. And AI is the next revolution. And what do customers want during this revolution? They want three things. They want innovation, they want to take advantage of it,
Right.
They want security, and they want choice. They want to be able to choose the technology that's best for them.
Now, they want you. I know your documents say, listen, they really want is they don't want to have cybersecurity as part of a big suite. They may want to have individual vendors, because if it's cybersecurity they need, it's not one size fits all. Is that a good way to view what you've been saying?
I think companies, what we see and what we're talking to the market about is that companies need to pick the right points of consolidation. They're not going to have one vendor. They're not going to have a million. And our pitch is simple. Identity is a good point to consolidate because you can eliminate redundant vendors. I talk to companies that have 50 identity vendors, and they can consolidate them into this one single identity security fabric, and they get security, they get a reduction in identity-based attacks, and they preserve choice. That identity system is not going to pick one platform or one collaboration environment. It's going to give them choice, which is the best of both worlds. Security, decreased costs, and choice and flexibility to chart your technology future. That's golden.
It seemed to me that your new emphasis, well, you've always been international, but the emphasis on big international, I was surprised. It looks like that there's more legacy and less protection internationally than there is in our own country. But are the bad guys going after the international companies too?
The opportunity is a global opportunity. Okay. I think what you see is that Okta's always been about the new wave of technology, whether it was cloud computing and mobile, and now it's agentic. Guess what the leader of technology is in the world? It's right here in San Francisco. So you see it start here and you see it spread out, whether it was cloud or whether it's now AI. And so you're going to see it as popular and prominent in North America than you will eventually internationally. So we're very excited about both opportunities.
Okay, reassure me. I haven't heard a lot of high-level ransomware attacks these days. You were the first one to alert me the whole process of ransomware. Is that because we're getting better, or is it because people are really quiet about it?
I think we're spending $200 billion a year on cybersecurity as an industry, and we keep having these cyber attacks. And our position is that identity is the core of 80% of them. So by solving identity-based attacks, we can solve all these attacks. But the industry needs to get better. We need to move toward this concept of an identity security fabric. We need to have these robust controls in place, especially as we adopt this new wave of agentic. It's a big task ahead, but I think we're all up for it.
Do you think, most of these people who are walking by, everyone is very excited, like you said. But do you think that this could be... Could someone get in and shut down the government? No, the government doesn't have agentics, do they, in a level that I don't want them to have?
I think there's an irony here. I think in some ways the most locked down, the most sensitive systems, the critical infrastructure, the core government systems are the most locked down, and they're the most used to dealing with cyber risk. And a lot of times in these attacks, Jim, it's the new things that are automated, the systems and the companies and the people that aren't used to securing things, like the core systems, that are the most at risks. Because when you want to block these attacks, you have to be comprehensive. It's not just the crown jewels.
Right.
You have to block everything to decrease your risk.
Well, I don't know. Look, I'm reassured by you, but I have to tell you that I didn't even know 6 months ago that this would be the way that they'd come in. I hope executives see it.
We're working hard.
All right. That's Todd McKinnon, co-founder, chair, and CEO of Okta, with a brand new way to do really well for Okta shareholders. I just wish it worked in the case. Thank you, Todd. Good to see you.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time for the lightning round. Coach Rhodes came back for quote these in the talk. Intended buy. Sells or sell just good. Of course, stock question. That's not my tip. It creates the episode of Fly. You playing us out. And then the lightning round is over. Are you ready, Ski Daddy? Tell me the lightning round. Let's go to John in South Carolina. John.
How you doing, Jim?
Couldn't be better, John. How about you?
Doing fine down here in South Kakalaki.
Yeah. Okay. What stock?
BLD.
Yeah, okay, building stock. I think the stock is well ahead of where it should be, even though I like the company. The rest of the cohort is down. I would do some trimming of that stock. How about we go to Nicholas in North Carolina? Nicholas.
Booyah, Jill, man.
Booyah, what's happening?
I'm calling in. I've been a fan for a long time. My mom's always said you were handsome. I'm calling in about a stock I bought last week at $12. I was up a heap a couple days ago. I'm up less of a heap now. It's ticker CRML, Critical Metals.
We've talked about this, Ben Stone and I. It is time to ka-ching, Critical Metals. You need President Trump to go in there and buy 10% of the company. I don't think it's going to happen. Mark in Iowa. Mark.
Hey, Jim, with declining interest rates coming, I'm shopping for some dividend stocks, and I found one with a big cash flow and a fat dividend, and I think room to run on the stock price. What do you think of Verizon here?
I think Verizon is kind of like a bond that can move up a little bit. I applaud your decision. With a 7% yield, I think it's a really good idea. Brad in North Carolina. Brad.
Thanks, Mr. Cramer, for taking my call. I wondered what your thoughts were on Revolution Medicines.
All right, this is a speculative situation on oncology play. I lost my mom. I've lost my mom to cancer. I wish they'd been working. This company existed during that period. I don't know if they have anything at all, but I always say yes to the speculative stocks that are trying to cure cancer. If someone gets it right, wow. Sam in Massachusetts. Sam.
Jim, how are you?
I'm good. How about you, Sam?
I'm good. You know, Jim, I came across this company that's trading at a really high multiple. It's expensive, but it could be expensive for a reason. I'm talking about Credo Technology. The company specializes in high-speed, ultra-low latency connectivity solutions. This is the stuff that connects the chips together. So your data center is only as good as the cables which connect the NVIDIA chips together. So this is a crucial part of the supply chain. Company's trading at a $22 billion market cap. Is expected to see growth of 30% this year. So I'm curious what you think about Credo Technology.
I agree with your analysis. Unfortunately, I don't know the company well enough to be able to offer an opinion. That's going right into the homework file. Let's go to Jeff in New York. Jeff.
Hello, Mr. Cramer. This is Jeff from Sodus, New York, on the South Shore of Lake Ontario, where the fall is in full swing. Leaves are changing, the apples are being picked, and there's a pumpkin in everybody's house.
And what the heck am I doing here? I like it out here, too, though. There's many places that can skin a cat. Let's make some money together. What do you got?
Mr. Cramer, this spring I called you because the potholes in my area were so bad that I thought this company has to make a ton of money providing the materials to repair them. You were nice enough to bring the CEO in the next day, and I like what he had to say. I bought some shares, the stock dropped, and I bought some more. I didn't get a full position before the stock started going up. Yesterday, it hit a 52-week high, and even with this pullback, I'm still up 36%. My question is, what do I do with the stock of Martin Marietta Materials?
Just hold it. I wouldn't buy more. No need to sell it. It's just a great long-term hold. By the way, so is Vulcan Materials, one of the greatest stock performers of all time. It's really kind of a duopoly. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, and the Oscar for responsible investing goes to Adam Aaron. Cramer's explaining the CEO's smart move with his own stock. Next.
Every speculative mania is ultimately brought down by greed, specifically the greed of insiders who decide to take advantage of the monster moves in their stocks by doing some extreme selling. Almost every morning during the last few months, we've seen some insane rallies in stocks. These moves are typically powered by small buyers, typically on Robinhood, who in the early hours move up non-institutional stocks pretty much effortlessly. Very similar to what we saw with GameStop and AMC in the heyday of the short-busting rallies of early 2021. We often think of GameStop as a short squeeze that somehow did not bring out insider selling. But that was a highly unusual situation. The debt-laden AMC situation played out in a far more normal and negative way. Back in the fall of 2021, after the stock had shot up dramatically, CEO Adam Aron announced he was raising some cash by selling some stock. It was, he said, for estate planning purposes. And hey, you can't blame anyone for selling to that kind of strength. He repeatedly said he would take some of his holdings off the table. But before, not after the sale, before. I like that. He gave you ample opportunity to get out ahead of him. That's not going to happen this time. In the second week of November 2021, Aron sold 625,000 shares. Taking into account a 10-for-1 reverse stock split and some other corporate actions that have happened since then, AMC was trading around $280. If you look back, the stock never traded higher. Aron unwittingly contributed to the top. These days, AMC trades at $2 and change. What can I say? Guy had great timing. It's this kind of insider selling that causes red-hot stocks to peak. Maybe you own some of these. At the same time, the company itself is typically doing the same thing. With AMC, the company sold $587 million worth of stock in June of 2021, after it had run to the 380s, but before Aron unloaded his stock. In other words, the company and the CEO sold a huge amount of shares. The company's sales broke an individual investor, created short squeeze, and raised a ton of money for the company. The CEO's sales, after the company's sales, marked the end of the move higher. The smaller Humpty Dumpty buyers couldn't put the darn thing back together again. For the record, I think it's good that Aron waited until after the secondary offering by the company before he sold some stock himself. That might not happen either. I bring this up because I expect the same process to play out, though, in many of the red-hot speculative stocks of today, some of which have gotten totally out of hand. Why? Simple. Because it always happens. We saw it in 2021. We saw it with the dot-com collapse in 2000. Fear that the stocks would come down, greed that the gains would be lost. Those are the fundamental components of human nature. They're not going to disappear anytime soon. The trick is to anticipate the secondaries of the company and the insider selling of the executives. Because if you wait for them to actually get started, you'll see your stock plummet, perhaps like AMC. Believe me, if you told those individuals who moved up the stock of AMC all the way to the 300s that it would go to $2 in a fairly short time, they would have told you you're crazy. They hated me for screaming sell, but I was right. The stocks fell apart just like we started seeing in the highest risk stocks today. Today may have been the beginning. Those who tell me now that I am the boy who cried wolf because they've made a lot of money are wrong. You don't make money in a stock until you ring the register. Never confuse stocks with cash. The quantum computing stocks, the rocket stocks, the nuclear stocks, the secondary data center plays, the flying cars, the critical metals, these have all gone parabolic. They're all candidates for insider selling and corporate selling because the companies themselves can't generate enough earnings to justify their current valuations, let alone sales. And believe me, the insiders know it. Just like Adam Aron knew at AMC. He was smart. He sold when the selling was good, both for the company and then himself. Be smart like Aron. Do some estate planning like he did. Sell some of your stock. At least take out your cost basis so you're only playing with the house's money. That's how you speculate responsibly. That's how you speculate. Believe me, you will not regret it. I'd like to say there's always bull market summer. I promise I'll find just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.